Akil, what's your thought on trading only using indicators like moving averages without using structure? If it's consistently profitable, then I'm okay with it. If it's not consistently profitable, then I think it's a bad idea. Is that a satisfactory answer, or do you want my kind of like a personal opinion, right? My opinion in general, for you guys don't spend a lot of time with me, I don't really care how you trade as long as you can be consistently profitable. That's my only job, is to help you get to the position where you can be consistently profitable. I don't care how you get there. I don't care what you do. Are you consistently profitable? It doesn't have to fit my belief on the market. I'm not a fan of moving averages on their own. But can you be successful trading a moving average cross strategy? Yes, there are plenty of traders that are. Now, obviously, it's not as simple as just looking for this EMA to cross over that EMA. Trust me, I've tried. You may have to add another indicator. You may have to add a filter. A directional filter, could be a structure-based filter, could be something else. You got to be efficient with stops and targets. That's a highly underrated part. I'll tell you what, that's a highly underrated part of trading. Everyone's worried about the damn entry, right? Everyone is worried about the damn entry. Where do I get in, right? In all honesty, guys, right? I would say, do I want to be on record saying this? I don't care. I am. I would say the entry is the least important part. I would say stops and targets are the most important part. Be honest with you. Right? If you think about it, yeah, and let me, for you guys, for you newer traders that are freaking out, I had this experience at the Traders Ball where I was talking to some traders that were a little bit more experienced, and we were talking about kind of the feel, the intuition. And you can see some of the newer traders like, no, what happened to all rules based? Like, before you freak out, you do need an entry reason. You do need to have a way to get involved in the market. You do need to be able to do analysis and tell you, what's a good point to get involved in the market. But the actual entry is a lot less important than where your protective stops are, where you want to be out if you're wrong, and your projection, right? And I see so many traders that they have this perfect entry, right? So they get into the trade, but they're horrible at stop losses, so they get stopped out prematurely. Or they're maybe too greedy with entries, so the market moves in their direction, but it never actually fills them. And at the end of the day, right, what's the point of a good entry if you can't project where the market's going to go? So I would honestly say the entry is the least important part, and a good way of looking at that is how many different ways do we teach you to enter a trade, right? Do we not have a scale from super aggressive limit order to super conservative 26-18? If it were truly the most important thing, that scale wouldn't be as large, would it? It would be like you have to get in when the market does this. There wouldn't be options of, hey, this or that or that. So I think the entry is the least important thing, and the entry is really more towards your personality and what you need to see to be confident enough to pull the trigger. What's more important is your projection on where price is likely to go and where price hopefully doesn't go. That's very, 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 very underrated. And I don't think, and maybe I'm at fault of this too, I don't think we talk about that enough. And I'm sure many of you guys have had instances where you've taken a trade and it does exactly what you thought it would do. It just doesn't get to your targets, and you're like, do I feel good or bad? So that's my feeling on it. I think the entry is, again, I'm not saying it's not important, but it's not as important as maybe some other elements. And there are many traders that get to a point where they see something like this and they're like, I just get involved in this zone. Right? Advanced patterns are a very good example of that, right? If we take a look at advanced pattern formations, right? And we say that, hey, we're looking for an advanced pattern to complete at a D leg, right down here, right? Is this D leg the area where price is going to reverse at? No, right? I mean, it could. We don't know, right? We're projecting that price is likely to reverse starting here, going till where? Where is our quote-unquote kill zone here, our potential reversal zone? To the X leg, right? So we're saying that we think price is likely to reverse based on this series of ebbs and flows, this series of very specific Fibonacci set in a very specific order. We're projecting that price is likely to reverse within this box, correct? Many of you are using limit orders to get involved in advanced pattern formations. You don't have to go that way, but many of you are. What you're saying is basically this: Akil, I don't really care where price reverses in this box. I just want to be involved in the move. Because I know that more times than not, price will reverse in some point between here and here, and there's a good chance it will go to here. And I don't care if I'm at the exact entry. I don't care if I'm at the very beginning, the very middle, the end. Doesn't matter. I just want to be in the move. I just don't want to miss the train. I can be the first one on the train. I can be the last one on the train. Doesn't matter. I just want to be on the train when it starts moving. Does that kind of put things into perspective for you guys? Aggressive limit orders are a great example on advanced pattern formations. Because we're not saying that price is going to reverse at D. We're saying this is the start. And we know that X is the finish because this is when it's invalidated. And we're saying anywhere in here it could happen. And if you're using a limit order, basically you're saying, look, I don't care where it happens at. I just want in. What's more important is where your stops are at if you're wrong and where you're projecting price to go to if you're right.